Hey, MCE crew, I hope your day is progressing profitably. Your money might be going a little further than you anticipated. Now, we're going to talk about inflation. We've talked a lot about inflation on this channel, and we're going to do so today in the context of some signs that may point to lower inflation. And if that happens, we're going to tell you what you should be doing in the event we don't get into this, big inflationary environment that everyone has been anticipating. So let's get right to it. The first thing I want to discuss is the fact that lumber prices have really, really dropped. I mean, they have crashed through the floor, basically. And that's a good thing for a lot of sectors of the economy, including real estate. And it's good for real estate because when individuals want to go out and buy a house, what will happen is if prices continue to rise, then a lot of people will find that housing is just unaffordable. And there's only so much that people are going to take when it comes to price increases on houses before they just say, you know what, I'll wait, I'll rent, and I will wait, or I'll stay in the home that I'm in. And when that happens, it locks up the market and you don't get as many homes trading hands or transacting. Well, if these prices of lumber come down, that may alleviate a lot of that. I'm going to link to all of these articles. Lumber prices on Chicago's Mercantile Exchange plunged more than 40% in June, suffering the worst ever monthly decline on record dating back to 1978. Prices are down 18% in 2021 and recorded the first negative first half since 2015. So remember, we did a video a while back, and I'll link to it here, talking about lumber prices had kind of hit the peak and that they were starting to show signs of coming down. Well, that has definitely followed through. Here's some more information. Lumber peaked in late April, May, at around $1,711 per thousand board feet. And as of Thursday morning, prices are down more than 4% to $684. So we've come down from $1,711 per board feet to $684. Okay, that's good for the economy. So let's hope that lumber price moderates, continues to even out, and that should help us see some moderation in the housing market as well. The demand for housing is also probably going to even out, considering we're through 2020. A lot of people had a lot of money in 2020, and it caused the housing market to, really take off, especially considering the fact that a lot of people learned that they don't need to commute into an office, that they can work from home. A lot of white collar, professional type jobs have their people working from home now. And as you hear, my cat is in favor of that. She likes company. So you're going to see more people, and you have seen more people moving out into, suburban areas that are not necessarily within a quick commuting distance of their office. Okay, another indication of what's going on in terms of price decreases. When we look at the oil market, crude oil, and we look at the futures contracts, right now we see them steadily dropping through April of 2022. So that's good news, because everything you purchase is, every product you purchase, services are different, but every product you purchase is transported. Okay, it has to get to you somehow. Now, either that means it's delivered to you via Amazon or whoever, or you go and you get it. And usually those trips involve putting gas in a tank and getting there via some sort of motor-driven vehicle. Okay, so the oil futures look like they're going to drop from the mid-70s all the way to about the mid-60s by April of 2022. So if that's indeed the case, and we don't get any shocks like any tankers stuck in the Suez Canal or any other types of disruptions to the oil market, that may bode very well for not just the gas you put in your tank, not just that price, but all of the costs that are pushed onto you from the transportation costs that companies incur to get your product to the final destination. Now, the other thing we want to look at here is right now, I'm sure you've witnessed this. You drive by certain places and you see now hiring at a lot of places. And that is as a result of people receiving unemployment. As the economy starts to wake back up from the shutdowns, we see more people demanding service. So you see more restaurant flow out there. You see more people at retail stores picking up things. People want to get out and about. They've had a year of being cloistered. So as these employees come back online from their enhanced unemployment benefits, it's forecasted that about 9 million people are going to return to the work rolls in September, because that's when the enhanced unemployment dries up. It expires, rather. So those people will be going back, and what's going to happen is when you flood the market with anything, it tends to lower the price. So we've got 9 million people coming back. We've seen all kinds of bonuses. There's a grocery store not too far from me that's been offering a $500 signing bonus to people to come and work. And I can tell you, they've only had one checkout line open for a long, long time. They can't get people in there to work. So as these 9 million people come back, you will see things like that $500 signing bonus go away. You will see higher wages go away. And when this happens, it has a direct effect on inflation. So Goldman Sachs, they predict that what we're going to see is a downtick in inflation because of all these people who are returning to the market, to the employment market, rather. And here's a little factoid from Goldman to help us understand the impact of higher wages on inflation. So if we're going to see the opposite of that, if we're going to see more people come back into the labor market, thereby making it more of an employer's market, then we're going to see wages moderate and fall. So this is what Goldman Sachs has to say about that. Goldman notes that academic studies of the impact of minimum wage hikes have found that sectors that use low-wage labor intensively pass roughly all of their labor costs, which are about 30 to 50% of total cost at restaurants and other businesses that disproportionately employ low-wage workers, on to prices. So Goldman is simply saying that when employees, there I did it again, when employers are put in a situation where they have to increase wages in order to get people to work, they will then increase prices accordingly or correspondingly in order to absorb that labor cost increase. Now, they go on to say that finding is roughly consistent with our own rule of thumb that a 1% increase in overall wage growth flows through to a 0.25% increase in inflation the same year, and a 0.15 increase the next year. So you can see they've done the math here. They know that wage increases have a direct effect on inflation. It increases inflation. And if we are seeing wages decrease, of course, we would have to expect the inverse to be true. So we've got three key sectors of the economy here that we're all seeing. We're seeing, over time, into 2022, early 2022, and into September with the labor market. Right now, with lumber, we're seeing these prices for these things fall. And if that happens, then it's going to take some of the steam out of what we've seen in terms of inflation. Now, Jerome Powell, the Fed chair, and Janet Yellen, Secretary of Treasury, have been saying that they haven't been worried about inflation. They have said that. And I've given them a lot of heat for that, because in the short term, we have definitely seen inflation, 6.6% here lately. So year over year, that is. So we have seen inflation, but they came out and said that they're not worried about it being sustainable. So I hope they're right. Now, as I promised, we're going to talk about what you need to be thinking about, because we've done videos telling you what you should do in an inflationary environment. And right now, I think that you should continue the course of boosting your opportunity account. Remember, we're not calling it an emergency account. We're calling it an opportunity account, because not only is this account supposed to be sitting there allowing you to take care of unforeseen things like 4 flat tires or a refrigerator that went up, without having to access credit that's going to end up costing you if you can't pay it off in the 30-day cycle. So we want you to have the ability to take care of those contingencies. But we also, or I should say, and we also want you to be positioned to take advantage of opportunities. Let's say a business opportunity comes up. We want you to be able to seize that, okay, if you've done your due diligence and you believe that this is something that you should invest in, okay? A stock that you, again, have done your due diligence on and believe that it's something that you should invest in. You've got to have the money to do it. So therefore, we recommend you have somewhere in the neighborhood of between 4 and 8 months of expenses. Now, we talked extensively about how you should arrange this account, because we've got some real criteria for it. It's got to be liquid. You got to be able to get a hold of the money. And optimally, it has to be earning a decent return. That money, it can't just be sitting over there and not doing anything for you. It has to be working for you, because chances are you're not going to need it that often. Now, one thing that you can do to arrange this opportunity account, and again, we're talking about inflation here. You have got to look back historically, and we've seen inflation go from anywhere between 2.5 and 3% on average over the course of the history of the country. So you should always be in a position where you are beating that. You've got to at least be earning 5%, 4% with your money, or you're becoming poorer because your dollar is becoming worth less. So we want you to, and we'll do a whole video on how you should arrange your opportunity account. We talked about it previously, but we're going to do a video just dedicated to that. So you want to have that money sitting over there in an opportunity account, getting a rate of return that is greater than historical inflation. Otherwise, you're becoming poorer. The other thing you want to make sure you do is watch credit. Okay, be very wise when you're dealing with credit. If you are using a credit card, pay that balance off within the 30-day cycle. That way you do not incur any interest payments on that, which makes the item you purchased more expensive. So that's all we have for right now, but I want you to just be very sensitive to what's going on out here in the market. And if we don't see a big time rise in inflation over the next 12 months, then still act like it was out there and put that money into your pocket, into your investments, into your opportunity account, and make sure you're getting a return that is going to maintain and grow the value of your money. So it has to beat inflation. All right, guys, I will talk to you soon.